Hi, I'm Plummet from Alpha Beta IR Analytics. Here I would like to talk about the huge dispute between the two main approaches in investing, active and passive. Let me start with this quotation from patriarchs of active investment management, Richard Greenwood and Ronald Kahn. They first established deep theoretical background of active investment management, which develops it as a serious branch of investing. Every development in active investing is being inspired by these two authors. I'm sure that if you are interested in active management area, you definitely are using in some form any of their formulas and ideas. Now let's read what they say in their book, Active Investment Management. Investors who don't think they have superior information should hold the market portfolio. If you are a greater fool and you know it, then you can protect yourself by not playing. This type of reasoning and lower cost has led to the growth in passive investment. Actually, Greenwood and Kahn wrote this about 20 years ago, but they were like prophets in our area. Let me show what I read when I open Bloomberg. What we see on this graph is enormous increasing in money investing passively, almost 50 billion net flows. Obviously this world is full with greater fools, and guys, they know it. I hope you will not be the next one. If we read again the citation of Greenwood and Kahn, we can see the reason of this strange situation in the financial market. Investors who don't think they have superior information. The whole story of active investment is about this. Hey, investor, do you believe that you have superior information? Do you think that some stocks will outperform others? If investors feel they do not have any information about the assets, they invest passively. They don't have any preferences on any asset to others. They do not have any expectations different from the market consensus about future performance of stocks. In this case, the most reasonable strategy for such investors is to follow the market or other benchmark they have. Instead of trying to beat the market benchmark, they prefer to get average return. How can they do so? By investing in portfolio with the weights of each asset equal to the weights of the same stocks in the benchmark portfolio. That is called to invest in the benchmark. You can do individually by constructing the same portfolio which imitates the benchmark portfolio. But financial industry has already developed convenient ways to invest in the benchmark. Index funds, exchange trade funds, etc. Of course, I'm going to talk about this part. Active management. Active management diverts from the benchmark. Assume so far you have behaved as a greater fool and therefore you have already invested in some market portfolio which is your benchmark. However, now you get some new information and based on it, you have higher expectation about several stocks. You strongly believe that these stocks will outperform next period. If it is so, of course you will increase the weight of these stocks in your portfolio. From the other side, you decrease the weights of stocks which, according to your information, you expect to underperform. Our team is really biased about active management, and there are several reasons which make us strongly to be in favor of active investing. Here we list the cases when it is appropriate to apply our approach. Actually, active management can be applied whenever you feel that you can analyze, you can extract information. If you feel that you have ability or tools to compare assets and to rank them, then active management is exactly for you. Active management is a very democratic process. It allows you to apply your level of knowledge. Never mind how sophisticated or simple is your method of analysis and making decisions, you still can apply the principles of active investing. It is equally appropriate for investors which uses sophisticated quantitative models and for those which base their decisions just on the opinion of investment advisor, or even on their feelings about future market development. Active management is not connected with specific timing of the market. Its idea to beat the benchmark can be applied in every stage of the market cycle. During the bullish or bearish market, investors still want to have performance better than the chosen benchmark. One funny side of active management is its simplicity. The approach is fully comprehensible, easy to be understood, seems like it is very easy. But from other side, behind this simplicity, there is a strong analytical background, strong investment logic, deep econometric understanding. As you see, it turned out that for the active management approach, the crucial element is information. Please refer to our videos or videos provided by our colleagues to learn how to apply active portfolio management for your investments. I hope you will be so excited about active portfolio management in a manner we, the team of Alpha Beta Analytics, are. Thank you for the time spent with us. I really appreciate it. It was plum.